The next part of this reading talk about factor-based strategies. So basically using this called factor model to do the job. But why we do that and how do we do it? Now remember previously we have discussed the style investment strategy based on different style. We're using the style box. So for example, if you want to create a portfolio is a large cap value fund. So what you do here is to select the stocks, all right, which is have large capital size and with very low book to market ratio or market to book ratio. So you use that the fundamental information from each individual stock, and then you select them and into this cell. So it's direct using the size and direct using the value index, information. However, it's sometimes it's have difficulty because you may not find the sufficient security you can do. Okay, you can do, for example, especially in the small cap area. So, what is the way to make this thing easier? Now, we do talk about this called stratified sampling. You can use sample to do that, but an alternative way is using a factor model to do it. Under the factor model is this structure here, is that if suppose you have individual stocks return, the return must sensitive to some kind of common factor. The first most important common factor, like Japan, is market risk premium. Okay, market risk premium. And the second and the third and many other factors, like this one, is a size premium. The size premium is the return between the small firm and the large firm. Because empirically we find that the smaller company had a higher expected return than the big company. So the differences there reflect the size premium. Okay, the size premium. And this one in Farmer Friends called HML is a high minus low. So that means the high value of the end market to book value, like a growth firm had a high market to book value, generate have a higher return compared to the low return from the low MB ratio, right? The market value versus the book value ratio. So the difference there is the value is the gross premium or the value premium, vice versa. So the idea is this, all right? Instead of looking for the large company or a low MB ratio, we can look at the sensitivity to that premium, right? So through this beta coefficient. So in other words, if the star may not be the small company, but it has a very sensitive high, there's a beta like 3. So it's very sensitive to the size premium. So we select them. If we want to have the firm which catch up this premium here, called the size premium, or the firm had a high beta for the growth or value premium. So this approach, instead of looking the firm basic characteristic, but instead of that, by looking for that company stock movement to the sensitivity of the stock movement to the factor premium. It's interesting, all right, and so it's rely on this model, of course, to do that. So here say that the factor is a return variable or characteristics which return on risky asset are correlated. So the beta is a correlation here. Okay, the higher the correlation, the beta, the more sensitivity to that risk premium. So what we do here is we're using those beta. Say, for example, my focus is on the size factor premium, so I can rank the stocks based on the size premium beta, all right, the size beta, so that I can rank stock for investment. And the purpose to doing that one is to predict future return on risk because we know there's a premium anyway on the size. Then I pick up the high sensitivity, the stock with the high sensitivity to that premium, and I expect that we will get that return. But there's one thing we have to make sure that whether that premium is a return, is a factor premium or not. So the factor need to, all right, be identified. So what is a factor? If whether this is really true factor, like size or value, we have to be empirically, experimentally prove that one it is a factor, because the factor has this very important characteristic, is that you have a positive association with a long-term positive risk premium. In other words, smaller company have the higher return than a big company over the very long period of time. It's still persistent with that excess return because the small firm had higher risk compared to the larger firm, and then there's for investor it should have this kind of premium as a reward factors. Okay, otherwise we call unreward factor. You're not going to get any return if it is they don't have a long-term positive risk premium. Why I have to mention this? Because there are so many factors now today in the financial market. Everybody is try to find factor in order to generate some kind of innovative fund. But not every factor is true factor unless it's subject to this particular requirement. The positive association with the long-term positive risk premium. Now once again, if we use the factor-based strategy, this is a quantitative approach, not the fundamental approach. So it has to be the rule-driven or rules-based approach. Right? So be careful. Next time in the exam, you have to make sure you understand that the factor approach is a quantitative rules-based approach. Now, if in the future you want to identify a factor, right? I have done that before. Like I try to identify a factor which is asymmetry short-term reversal factor. It has been a market continuously persistent, have the long-term market risk premium there, or we call a reward factor. So you have to do a very careful procedure to test that. We call back test. So how do we do? There's a procedure to identify whether this is a factor. Okay, there's a factor. So now if you already identified a factor here, like size factor, that's very famous, or I can define my factor, and I believe from my study there's a short-term reversal factor. In a short period of time, some of the depressed stocks will actually rebound. Okay, in terms of price. Now, if that being the case, I have to do is all right. I'm going to select all the stock S&P 500. I want to see every stock had a sensitivity to that factor, and I can do that one based on some kind of measurement called Charles ratio, for example. If this is a beta, then I rank those investable stock universe by that particular factor procedure. So I rank from the smallest one to the highest one. Okay. So how do I do that? When I rank that one, I divide the universe of the investment, all the stock, based quintile or quantile or percentile, whatever you want to do it. But most likely we use quintile to do that. And then we select, right, if this one has a persistent, prolonged, rewarding factor or premium, then we can hypothetically form a long-short hedging portfolio strategy. For example, if you rank from the quintile, so from the first quintile 20% to the last quintile from 80 to 100%, then you believe that the highest quintile will give you a higher return than the lowest quintile. Then you use a strategy, say hypothetically, you're going to long the highest quintile and then short the lowest quintile. And then you want to see that return, whether it's persistently over time, is a positive, right? At least the risk adjusted average return has to be positive. Okay, so this return on the performance of the long short strategy is tracked over time and represent the return of the performance of the factor. If the performance is consistently, all right, or persistently over time, then consistent over time is positive, then you can claim that one is a factor. Then you can form an ETF or portfolio to do that. But this procedure has some drawbacks. You know, if you use the long short between the highest quintile with the lowest quintile, you're assuming that the relationship of return and your beta, right, because you rank by the beta, it's a linear relationship. Meaning what? If you got a 1, 2, 3, 4, 5, the 1 is the smallest one, and then 5 is the highest one, but the 2, 3, 4, they all monotonically increase. So there's no truncate between them, which is not true most of the time. A lot of time they are non-linear related. So you have some kind of truncation in the middle of the quintile or quantile. So for example, you have the middle one actually lower than the first one. Then how do you deal with that? Right, so that's the problem there. If you see there is a nonlinear relationship with the quintile, then I don't think, my personal viewpoint, is not a factor. It's not a factor. So here say that most are likely all those models assume the factor in the stock return is linear, which is generally is not true. Okay, so we got to be careful next time when you do the analysis. You have to make sure if this is not linear, then we cannot claim it's a factor. Another one, if you have a multi-factor, like we got the size and value, remember though, those factors are highly correlated to each other. This creates a statistical problem. You got to remember like this regression here. This is called a dependent variable. This is called independent variable. Independent meaning what? Uncorrelated. But if you have a high, strong correlation between SMB and HML, then you blow out your model because this is called multicollinearity problem in the statistical term. So that is another problem that how do we adjust that? I have an article published a couple years ago is to do some adjustment. If they are correlated, I can do some orthogonization process to make them independent. But again, still statistical approach means you may destroy the regional pricing model. Okay, and the final one, a factor may have exposure to other risk factor. In other words, since they are correlated each other, you may not think this is just the size factor versus the value factor. There's something between them. Okay, so it's not a clear cut. So these are the major problem with the factor-based strategy, all right, or those model.